The war in Ukraine will ultimately end, but the US has gotten its way for now. Europe is largely cut off from Russian energy. Last month, explosion put Nord Stream 2 out of commission. It was a state-level terrorist attack that seems un-European. The European political leaders were muted in their response. They no doubt realized the world has entered a new era. Fossil fuels are the most pivotal commodity. The trade in energy represents about 8% of global trade, but is indispensable for 90% of global economic output. Even the green tech revolution is impossible without it. Oil is priced and traded in US dollars. If a French company buys oil from Saudi Arabia, the dollar payment goes through a bank in New York. The same applies to most other commodities. If Japan buys Australian wheat, New York banks process the dollar-denominated payment. At the same time, the US dollar as the global reserve currency has reached its past due date. As a matter of fact, with the US dollar being increasingly weaponized by a self-serving Washington, countries have been seeking reliable alternatives to regain financial independence. The US dollar has been the world's major reserve currency for decades, but that status could come under threat as very powerful countries seek to undermine its importance. Let's find out more. The decision to remove Russian banks from the SWIFT financial messaging systems and sanction the country's central bank has been popular among the general public, but has raised many concerns. Further sanctions on Russian commodity exports might roll the global market and further fuel the inflationary dynamics that have caused food and energy prices to skyrocket in recent months. Even since the US dollar replaced the UK's pound as the global reserve currency, America has come to depend on its exorbitant privilege to a considerable degree. The dollar's final status as the world's reserve currency ensured that there is a strong and persistent demand for dollar-denominated assets worldwide. It also enabled the US to run persistent trade and current accounts deficit. Furthermore, the desire among foreign central banks and private parties to hold US Treasury is to a large extent depends on the dollar's critical role in the international financial system. It has also allowed US policymakers to pursue excessive fiscal policies for decades without having to face significant market discipline. The US government took debt creation to a new level in the aftermath of 2008 financial crisis. Several banks, which were considered too big to fail, faced bankruptcy. The US government spent billions to avoid a financial catastrophe. 10 years later, the government added trillion more to the national debt to deal with the impact of COVID-19. Between 2008 and 2020, US national debt grew from $9 trillion to nearly $30 trillion. With the dollar decoupled from gold, dollar-denominated debt started to resemble a Ponzi scheme. The pandemic shock has already raised concern about the future of the US dollar-centric global monetary order. The dramatic expansion of the Fed's balance sheet and the explosive growth in public debt levels have led some to fear potential fiscal dominance of monetary policy in the years ahead. Furthermore, as stimulus-fueled spending patterns shifted from services to goods, the US ran up a sizable trade deficit with China over the past couple of years. To better understand how this system works, we need to take a look at how the US dollar became the global currency. The dollar became the world's reserve currency in 1944. The Bretton Woods Agreement made the gold-backed dollar the anchor for the global monetary system. Fixed at $35 an ounce, dollar could be exchanged for gold on demand. The Bretton Woods systems gave the US virtual control over the global financial system. However, Bretton Woods came under pressure in the late 1960s because the US started spending more than it earned. As the US started accumulating huge deficit and running out of its gold reserves in the late 1960s, the government found it too expensive to maintain the promise. And so, in 1971, President Nixon arranged a divorce between the dollar and gold. The dollar's value is now set by a mismatch of political and economic forces, ranging from central banks' decision to buying and selling of traders around the world. The US dollar has been the world's major reserve currency for decades, but that status could come under threat as very powerful countries seek to undermine its importance. Warm Annie Corin from the Institution for the Analysis of Global Security. The dollar's share of global reserve is expected to continue its downtrend as emerging markets and developing economies' central banks seek furthermore diversification in the currency composition of their reserves. Major movers such as China, Russia, and the European Union have a strong motivation to de-dollarize, said Corin, co-director at the Energy and Security think tank. We don't know what's going to come next, but what we do know is that the current situation is unsustainable because you have a growing club of countries, very powerful countries. Corin said, many central banks worldwide traditionally have US dollars in their rainy day fund for continuous stability. Data from the International Monetary Fund indicates that reserves have been coming out of the dollar and flowing into other currencies. The share of US dollar assets among the foreign exchange reserves of global central banks has dropped to a 25 years low, driven by exchange rate fluctuation and central banks' action. In recent years, China has tried to internationalize the use of its currency, the Chinese yuan. Such moves have included the introduction of yuan-denominated crude oil futures and reports that China is preparing to pay for imported crude oil in its own currency rather than the US dollar. China, Thailand, and a number of other countries are testing a new cross-border payment system based on the technology developed for the digital yuan. Russia and China have agreed to use the yuan and the ruble for the trade in Russian energy and Chinese technology. Most concerning of all for the US is Saudi Arabia, the most influential member of the Organization of the Petroleum Exporting Countries. The Saudis are in talk with China about selling oil in yuan. China is Saudi's main trading partner. The growing de-dollarization in Asia explains why it's crucial for the US to keep Europe in the dollar camp. It is necessary to prevent growing economic ties between Europe and Asia, which explains attempt by the last 4 US presidents to torpedo Nord Stream 2. Euro-Asian economic region of 93 countries and 5.3 billion people trading among itself will not need to rely on dollar. The demolition of Nord Stream 2 removed an important bargaining chip for a compromise solution to the conflict. But why are these countries trying to escape the dollar system? The phase is likely to accelerate with Washington imposing financial sanctions on other countries from time to time and using the dollar dominance as an intimidating tool for geopolitical enforcement. But one factor curbing countries' enthusiasm for the greenback is the prospect of being subject to US jurisdictions when they transact in dollars. When the US dollar is used or transactions are cleared through an American bank, entities are subjected to US jurisdictions even if they have nothing to do with the US, Corin told CNBC. After Moscow launched the military operation in Ukraine, Washington has maneuvered a raft of sanctions against Moscow, removing Russian banks from the international financial messaging system SWIFT, freezing any Russian asset touching the US financial system, and threatening to crush Russia's economy. In response, Russia has developed its own financial transfer system, the System for Transfer of Financial Message, as an alternative to SWIFT and require unfriendly countries to pay for gas supplies in ruble. Using financial sanctions can only encourage other countries to move away from the dollar and look to other currencies for credit and as a store of value. Experts have warned the United States against using financial and other sanctions against countries that oppose its policies. The United States could grab anybody's gold who did not follow American policy, stealing their foreign exchange and saving, said Michael Hudson, professor of economics at the University of Missouri. The ongoing monetary tightening by the Fed, as well as increasing oil and food prices, could plunge third world countries into bankruptcy and push them to sell public assets to American investors, said Hudson. The balance of payment with African and Latin American countries is going to run into deficit due to an inflow of investment money, as well as higher prices of oil, food, and foreign debt. Essentially, the United States is using monetary policy with Federal Reserve to bankrupt third world countries. Multiple cases of economic and financial instability amid the dollar's ascent can merge into a bigger, more dangerous combination of damage, global growth, debt default, and social, political, and geographical instability. Thank you so much for watching. As always, if you find this content helpful, smash that like and subscribe button, turn on the notification bell to be notified every time I post a new video, and see you in the next video. Stay safe.